Hey guys, super happy to be here once again on the Blushing Quants. And today I'm very happy to have Vincent. And Vincent is doing something that we haven't really spoken about it on our show before. And I do think that his perspective and point of view will provide you with a plenty of ideas of how portfolio manager or portfolio management is supposed to be done in a quantitative manner. By the way, just a few notes. I read a lot about people that aims to revolutionize portfolio management with the quantitative development. So I do think that conversation will be very helpful for you to expose and to get much exposure to how this less technical interpretation side of the business gets much more technical and much more comprehensive as we tend to speak. So I'm very happy to have you, Vin. How are you today?
I'm excellent. I'm excellent.
Yeah.
Yeah, happy to be here. This is an interesting topic. I think you guys have a unique, conversations, and I think what we do is extremely unique as well. So I think this will be a great talk
So
for your
two unique
listeners.
people. So as you say, two unique people, master sure to have a unique conversation.
That's the
That
goal. Let's do it.
that's what you're directing to. Okay, so hopefully we'll have one. I do believe that we'll have one. So before we get into the conversation, tell us a little bit more about you.
Yeah. So after 25 years on Wall Street, big firms like Morgan Stanley, UBS, ICAP, I noticed a recurring kind of like industry paradox, right? Where you have more data than ever, yet less clarity on how to actually implement that data and how to manage risk. So that gap led me to build what's known as Defender, which is our rules-based framework, which is totally quantitative, that helps investors and advisors make more objective decisions, and also to establish my first company, ViewRite Advisors. So that was about a year and a half ago. But currently, I manage an ETF portfolio here in the U.S. Is the Defender Risk Adaptive 500 ETF, that is ticker SPDF. And we use systematic breadth-driven framework to adjust our equity exposure as market conditions change. So that's really making it an institutional grade risk management accessible to everyone, and that's really my goal with doing the ETF. Previously, um, I led the technical research effort at CFRA Research and Lowry Research, where my analysis was, cited in a lot of the financial media, and I've been doing, interviews like this.
Really? So let's talk about it before we start to dive deep into your the gap that you were founding. Um, I would like you to explain more about your discoveries and about what you were working on academically speaking on your portfolio management, investment, and innovational side.
Yeah, so I mean, I'm a chartered market technician, so my focus on technical analysis is how I have always, provided an edge to my clients and in my portfolio management process. And key to that, and my specialization in particular, is market breadth, right? And I think there's a really important case to be made that market breadth needs a heavier weighting in terms of portfolio management. And simply because we're in an era that we're in where it's a winner take all type mentality when it comes to the stock market, right? You have in a lot of stock markets around the world, not just the US, you have a few names that are extremely large in terms of their market cap. And because the indexes that we track are market cap weighted, you can sometimes look at the index from a price level and have a totally different interpretation of what is actually going on under the surface. And that's why I talk about market breadth, because it counts each market participant in terms of the stocks in the stock market independently, and it gives them an equal weight. So you have an understanding for how strong is the market really. It might look really strong on the surface, as it often does at the end of bull markets. It looks quite strong, but invariably under the surface at almost every single market top is a deterioration in market breadth, which is simply counting all those stocks that are in uptrends or that are actually participating in the advance underneath the surface. And that's what we choose to really examine and dig deep in, and really not a lot of other folks out there who do that.
So what you're actually proposing is that you're tending to take market exposure and to have a deterioration and to examine in a sense where you try to expose where or what exposure does any equity has
So what we're trying to do is determine what is the true health of the market, and based on the true health of the market,
based on the
how,
exposure for the asset.
right, then how would
Oh,
I
I got it.
be?
So
Yeah, yeah. So I'm talking about the market broadly, right? So for example, if if right now we have 50% of stocks trading above their 200-day moving average, yet we have a new all-time high in the price indexes, is that a particularly healthy level? No, it's not. You only have stock half the stock market, or half of the major components of the stocks out there are in downtrends, and half are in uptrends, but yet we're making new highs. So that leaves you with some fragility in the system. So what our system does then is, from a quantitative perspective, we look at breadth, we look at the numbers, we crunch the data back 100 years, and we determine what is the regime, quote unquote, that we're in right now. And based on that regime and history, how would I invest accordingly? So what we'll do is, when we see the evidence of fragility building in the market via these breadth tools that we use and these proprietary calculations, then we scale out of the market in 1/3 increments. So again, it's all rules based. So this set of criteria occur, we sell 1/3 of our exposure. This set of criteria occur, we sell another third, and we could potentially sell a final third so that we're completely out of the market into T-bills. So that's how it would work on the way out. Now on the way back in, because there is this asymmetry, if you think about it, in bull and bear markets, where after a bear market has taken place, you've realized all of the risk. The risk has been taken into account, and now your expected return picture is skewed to the upside. So in order to take advantage of that, we don't scale back in. We are just all the way back in. So if we've scaled out, that's one thing. That's how a market deteriorates. It actually deteriorates slowly over time. Different stocks peak at different times, but often, as you get to a bottom, almost always you'll get a much higher correlation between stocks and concentration and clustering in terms of where that bottom is. So your bottom is going to be quicker, and it's going to be more powerful, and you'll tend to be able to capture that better if you're reinvesting all at once. And then once we are in bull markets, say we're fully invested, what we will do also, again, another system that's in place on a tactical basis, is to buy the dip. I mean, that's the other thing people want to do. Avoid the bear markets. That's what Defender is primarily designed for. But then secondarily, in a healthy bull market, what do we want to do? We just want to buy the dips, because those are just advantages to add a little bit of alpha to our portfolio here and there. And those are going to be more frequent than identifying a major market top. So we'll just take advantage of those opportunities to add a little bit of alpha along the way when we buy the dips.
Mhm. I got it. Well, first and foremost, it sounds interesting, but I would like to ask you, you're actually compressing 100 years of data, which most of the data is not very just assuming most of the data is not very efficient, and you're trying to recreate or rethink about a history about historical events on and predicting like the minor artifact of the fragility in the market. So for example, if you have an asset and you think about its fragility, or you think about the fragile occurrences or the good movement with another derivative asset. So my thought leads me towards a way that you're actually trying to recreate historical events in the future that will be making an assumption about like how the reaction of the PM supposed to be, or making a reaction of how the market will react to. Which one is the most which definition is the most accurate?
So what we're trying to do is learn from history because people have a very short memory when it comes to history. So if we take that many cycles through history and we could identify what were the factual conditions that led to the peak, right? And what you find is actually in over 90% of market tops, you have a negative divergence between breadth, which is all those internal factors that we study, and the price of the index. So in other words, the index price will be looking very good.
Just a question. Those internal factors, who designed them? You designed
So
them?
they are factors that anybody can find anywhere that has a
Where?
good
On the
access to
French?
data. So, I mean, I use Optima, for example, and what I'm able
Yeah.
to plot is advanced decline lines. So I like to look at the New York Stock Exchange all issues advanced decline line. I like to look at the common stocks only advanced decline line. I like to look at the S&P 1500 advanced decline line because that combines, regardless of exchange, the S&P 500, S&P 400, S&P 600. So I'm getting the large cap, the mid cap, and the small cap all kind of equal weighted within that breadth index of the S&P 1500. So those are just a few things I like to look at. And I also mentioned earlier the percentage of Russell 3000 stocks. So you've got 3,000 stocks now in that index. What percentage of those stocks are trading close to new highs? What percentage of those stocks are trading above key moving averages? So these are some of the data points that we're looking at. I just apply my filters and my thresholds to those well-known data points. I haven't invented anything on my own in that regard in terms of a new indicator specifically. It's just a rules-based program around these well-known indicators of market health.
I do see that there's a certain distinction, a very big differentiation from how people are actually tackling, factors and regime detections. I had here Paul Blocken, which is the quantity of the year of 2023. He's responsible for 92 papers, academic papers. And one of his, I think, most significant paper was about market regime detection, and he using kernel signatures in order to sign or in order to assign a certain number or certain characteristic towards a type of market movement or a market behavior. And I do think that quantitative look or point of view over um, over a certain look that looking at the data as it is, as like the entire data set, and trying to rethink about how to recreate the history, but the history not all the time can be rewritten. Now, I would like to ask you because of there is a an academic work about market regime detections with kernel signatures and and with um, with market maximum mean discrepancies and all those those mathematical tacklements. And I would like to ask you, how do you refine it from from your perspective, because I do understand that there is not a deep conversation about the artifacts that the market leaves, but you actually look in a certain level of the picture, you stop at a certain level, and then you try to rethink or restructure your portfolio based on that. And I would like to ask you, what is the deepest assumption you're receiving from the picture, and how does the picture enables you to assess risk better? How does this picture enables you to move onwards with your assumption and so on and so forth? Because I will tell you, what do I ask it? Why do I ask it that way? Because I think I told you about the differentiation. This is not this is not a thing that I think and say just here, but I do encourage that thinking process or thinking curve of a portfolio manager tending to move or to dive into the quantitative space, and to see how he integrates his own intelligence, because most of the quantitative researchers has no relationship to the financial markets, they come from physics or mathematical background, and you tend to come into integrate your own intelligence, your own intelligence that you have gathered over the years with a certain quantitative understanding, which the quantitative understanding is not very deep. And how do you then accumulate two types of understanding to enhance profits?
Yeah, I mean, I love the fact that you brought up regime identification because that's core to our process. We operate within four regimes, and we label them
Sure.
as such. So that's it's such an important way to think about it. And you're right. Um, I came from, my degree is in economics, but I started straight out of school at Morgan Stanley, and I'd been in financial markets, ever since on the equity side. So it was all informed by sort of trial and error and what I had learned from the smartest people I'd come in touch with through my whole career and through my own mistakes. Frankly, I think that's the best teacher, right? Is making mistakes on your own, losing money, your biggest losses, that should be your biggest value because you're learning the most from those. And one of the things that I learned early in my career is it doesn't matter how good the story is for any stock, if the environment is against you, you're swimming against the tide, right? You're not going to get anywhere. You're not going to certainly get to where you think you're going to get. A, and then B, as it relates to the story and the fundamentals, those are subject to change. So what we need to do is be adaptive about how we interpret data. So that's what the biggest point that I would make in terms of my process is that it integrates a level of understanding of, again, 25 years of in the business being very specific in terms of technical analysis and breadth analysis, and then 100 years of tops and bottoms incorporating all of that learning that other people had to do, right? Because in
Hmm.
hindsight, it's easy to study that, right? And to learn from the mistakes of others is actually the wisest thing you can do. Again, in addition to my own mistakes, and
Hmm.
then seeing my interaction with so many portfolio managers through the years, and what I felt was missing was a systematic element to really to get to implement all of this data that's flying at people. And I just feel like there's just more and more data, and some of it is just not as useful as it could be. And that's why we need to figure out, at least for me, what's your edge, how to exploit that edge, and how to do it in a systematic, repeatable way. So that's where I'm focused. That's how this all came to be.
Hmm. That's very interesting. You have mentioned that you were learning from your mistakes, and I would like to hear a story about one of those, if possible. We haven't spoken about it, offline, but if it would be possible, I would love to hear one of your great stories.
Yeah. So one mistake I could think of was, and this is on a single stock, and it just relates to that idea of believing a story and thinking that that story is going to come true, and that those earnings are going to come true, and that's going to drive the stock higher forever. Was a certain pharmaceutical stock back in about 10 years ago, and stock was trending really well. It was above its 200-day moving average. It was behaving like it should. And I was like, this is a great stock. I want to hold this stock forever. And then the more I learned about the stock and the more I learned about the fundamentals, in particular, other people who own the stock, famous fund managers or whatever, I almost like fell in love with it, right? Which we know is
Hmm.
dangerous. And I saw that stock later break its 50-day moving average, have its break its 200-day moving average, have its 50-day moving average cross below its 200-day moving average. And I didn't do anything. All those steps, I didn't do anything because I believed that the fundamentals were gonna prevail. And what I had learned about the technicals, so maybe that wasn't gonna work this time. And that only reinforced that mistake. Eventually did I did, clear myself of that situation, but not after, I had a significant loss. And that reinforced my belief in technical analysis and in particularly systems about managing risk, right? So that's one side of the equation, not being able to sell the loser, right? I think that's a really important thing that you probably, I'm sure, talk about a lot on this show and have people talk about a lot, is just that
Hmm.
idea that you need to sell the losers. The other thing on the opposite side of the equation is in 2007, 2008, I called that really well. I got out of the way, and this was kind of earlier in my career, but I had enough money for it to matter. So I did get out of the way, and I did use breadth to do that. I had a really good system, even at that time. Uh, this was, again, many years ago. Even at that time, I had a very good system for getting out. It did not have a very, how I found out later that it did not have a very good system to get back in, right? So that was a primary weakness. In fact, I felt like because I had got out so cleanly ahead of that bear market, I really didn't lose any money at all. That it really didn't matter when I got back in. I would still be better off. And that's true, but it's like, why not get both sides of the equation if you can, right? So again, I didn't have a great process to get back in. So I end up getting back in quite late, which of course costs you money, right? So that was another part of it, right? Where, okay, I wanted to get, because I already had this topping process pretty well mapped out. Of course, I refined it and I put quantitative parameters around it later. But what I really wanted to work on was that second part of the equation, because honestly, the market goes up 75% of the time, at least the US market does. So we want to actually be biased to the upside. We actually do want to have a better process about getting back in. So that's why that process came about and the way that it did. I'm fully back invested. I'm not scaling in. I'm fully back invested after that bear market because my risk return has been, turned on its head in terms of the asymmetry. I've got a lot more expected return versus the risk that I could potentially realize after a bear market. So I'm actually more aggressive at that point. So my system is designed to be quite aggressive after major bear markets for that reason.
Hmm. Very interesting. And let me ask you that way. Okay, so we have spoken about your research, market breadth, and so on. But I'm very eager to learn about portfolio construction from your perspective. How do you construct a portfolio? How do you know which factors each and every asset that you would like to trade or you already have a position in? How do you discover the underlying factors that applies to your positions and into your assets? How do you assess your risk in real time, and how do you take that proper understanding to and apply it practically over over your portfolio?
Yeah. So in terms of the ETF that I'm running right now, it's on the S&P 500. So there's no selection that really goes into that. It's really just about how do we manage risk within that framework. But in terms of my own portfolio and then in the past, what I've run, I've really focused on momentum and really relative strength. So, you look at the universe of stocks in a certain way and you say, well, the strong tend to continue to be strong. In fact, you look at the history and the studies that have been done out there, one of the only um, really the framework that works most consistently in the equity market is momentum. And there's no better example of the S&P 500. I mean, it itself is a giant momentum index because these are big, successful companies that are getting rewarded by more and more and more capital. That's what momentum is, right? So, uh, success begets more success, in other words. So that's a key principle for me. So when I was, outside of the ETF, running my own money or helping others run their portfolios, meaning financial advisors, what I'd often do is gravitate toward that framework, right? Of course, you want some degree of diversification, so you're not too concentrated in too small of an area of the market because risk off happens fast, particularly in momentum, right? In momentum driven markets, like we saw with tech just Friday, right? Where we had many that the tech stocks down quite big, right? So we don't want that situation where you're overly concentrated, but you want the strongest fighters in every sector is sort of the way that I look at it. Is like if I'm building a team, I want to look at all the sectors and I want to weight them in a way, A, that represents their strength as a sector relative to other sectors. But then B, within those sectors, I want to be in the very strongest stocks that are representing the industry groups that are contained in that sector, right? So it's again, you kind of think about it like a draft. It's like I'm going to pick the best players from the best teams, and those are the ones I want on my team. And the ones that are not performing, well, then I can sell them off when my conditions, when my fragility creeps back into the market and I get my conditions to sell. Well, then those will be the first out the door. The ones that are already not pulling their weight, they're going to be the ones that are going to get sold. So that very much is a key framework for me in terms of not only building the portfolio, but also the risk side of managing the portfolio.
I got it. Okay. So let's get back to technical analysis. I would like to ask you about technical analysis in in a quantitative space. How do you know how to leverage, or how do you see, or how do you actually make the graph interpretable in a way where you can extract numbers and you can assess your position entries in a way where you think about risk management, and how do you assess your risk better when you do look at the graph and when you do look at visual understanding, not just the mathematical occurrences, but looking at what you are able to look at and to assess risk better with a quantitative point of view.
There's a lot of nuance when it comes to the art of what I do because we know part of it is science, part of it is math, but there's also a nuance to it. And I'll give you an example. So one of the indicators that people like to use is the moving average, and where a stock is relative to its moving average, I think is important. But it also is important is the slope of that moving average. So it's one thing to say that, stock is above its 50-day moving average, but it's another thing to say that the stock is above its rising 50-day moving average. Because if it has a rising 50-day moving average, for example, then I have more information to go on. It tells me that my momentum is actually to the upside. My trend is to the upside. But if it's simply above its moving average and the moving average is down, well, that could just be a rally in a bad market. That doesn't mean anything. So you need to kind of configure your points in a logical way, um, not just strictly mathematical. And that's where my 25 years of experience comes in, is that I understand those nuances, and I'm not just thinking about it as AI would, which is just in a very sort of binary, non-nuanced way. Is it this or is it that? Well, great. It is good to be quantitative in that way, but there are nuances to this. This is art and science together. So and I think that's a good example and a way to answer your question. But it's there are plenty of different examples I can give, but that's just the first that comes to my head that demonstrates that point, I think, effectively.
Mhm. Okay. Let's get back to asset identification. How do you look at assets? What are the most critical things that you think about assets or new positions where you understand the reality of the market and you say, okay, my hypothesis has been built on top of a very understandable business case. How do you know how to select those type of assets, and how do you build a strategy that where you already know, and we are already aware about your risk, and you're already aware about how to align potentially how your hedging processes on top of it, and take all of that into consideration when you're looking at a particular asset.
Yeah, so I mean, I'm strictly a stock person, so that's where my history is. So when you talk about, asset, my asset is always going to be equities, but within that, of course, there's different stocks that you can consider different assets. And again, I would just go back to my earlier answer, which is that this is very much um, a strong get stronger type of a world. It's always been that way. In human history has always been that way. The strong get stronger, the weak get weaker, or they go away. Same thing with companies, same thing with stocks. So you want to keep buying strength. And as stocks get weak, you get rid of them, right? As they continue to strengthen, you continue to hold them. There's no reason to. But this is why I also like when it comes to single stock positions using a some sort of a trailing stop methodology, right? Because we don't want to be stuck in that position that I described earlier with the pharmaceutical company where we're writing it down regardless of what kind of momentum it had in the past. That doesn't necessarily transfer into the future. We understand that that is the tendency, like physics, something in motion, an object in motion is going to continue to stay in motion unless a force is acted upon it. Well, sometimes forces are acting upon it in the form of selling under the surface that we can't necessarily see. And that's why, in order to keep ourselves in check, our emotions in check, and stay very focused and quantitative and make sure this is very clean, then we use trailing stops to get out of positions that are no longer have those types of qualities that we want.
Hmm. I got it. Very interesting. Um, I do think about your research for a moment, and I think about those factors that you're tending to think of. And my question for you, or my assumptions for you, are would be that okay, once you selected a subset of factors, how do you know which one has the most relevancy in terms of assessing risk, and how do you know which one has the most relevancy where you assess how do you approach a market in and how do you add yourself from risk exposure towards another proven asset? How do you identify correlations, and how do you think about like thesis and thesis orientation where you try to deploy a position, like on an institutional perspective, with an alignment to institutional perspective.
So I think it's important to acknowledge that correlations are always changing. So what was once a relationship where um, stocks go up when rates go down, when interest rates go down, that's not always the case. That correlation changes. Sometimes different sectors are correlated to each other, and sometimes they're not. So I think it's really important to continue to test that framework, which again is why regime is so important. To understand my regime is to understand my environment. And if I understand my environment, I understand what correlations are most likely to work and most correlations are going to break down. So in terms of regime analysis, that's why it's very much for me top down. I need to understand what's going on bigger picture in terms of my regime, which regime we're in. And then from there, I can make other decisions. But that it all stems from that regime. So to me, that's the most critical piece. The other stuff almost is such a minor importance. If you're able to ride the waves in the right direction, then it really doesn't matter, what kind of surfboard you have to a certain degree, right? You're still going to catch the wave. You're still going to ride the wave. You're still going to have a good ride. There's varying degrees, sure, but if you can get that right, then you're 90% of the way there. So that's why I focus so heavily on just getting that regime correct. Everything from there
Mhm.
follows in.
Mhm. I see. Okay. Let's talk about CMT. I saw that that you're associated with CMT. Let's talk about this communication or this association a lot more.
Yeah,
Let
so the
let me
chartered
know what do they do.
yeah, so chartered market technicians um, have the CMT association, right? It's almost like the CFA society, but for technical analysis. And it's something I was introduced to very early in my career. Again, I started my career in 2002. So that was like the bubble had just burst. Stocks were going down almost every day. Um, Risk management became something very real. And also, who becomes very popular in bear markets? If you notice this, even today, this is true. When the market's down big, who are they going to have on CNBC? It's going to be a technician. The technician is going to want to tell is going to tell the audience, here's what to look for next. Here's where the next stop might be, and here's where we are right now. everybody wants that. In a bull market, they don't really care so much. When the markets are going up, they don't really care. But in that environment, again, how I started my career, that was really important. It became really important. So I learned a lot about it. And again, it was a way for me to set myself apart from my competitors, you know, how the advice I can give was more complete when I had the technical picture I could include. Because a lot of people can talk the economics, the strategy, the fundamentals, the earnings story, whatever, right? The stuff from the analyst. But not a lot of people could correctly incorporate the technical side of the equation, which is why in 2008, I studied for the designation. It's a three-part test, and I can guarantee it's going to make you a better investor and a better trader if you do that. In fact, I know a lot of friends at this point who are also portfolio managers or CIOs who are CFAs, so they have that fundamental background, but they're also CMTs. And they said they always when they're speaking to audiences, many times they'll have this self-effacing moment, and they say, honestly, the CFA helped me get my job, and the CMT has helped me keep it, right? Because the CMT is all about sort of rationalizing and deferring to the market as the most important factor rather than my estimates. As a fundamentalist, my estimates are the most important factor, but as a technician, the market is the most important factor. I mean, who should you be listening to about the health of a security more than its own price, right? It makes sense logically that that's where we go. And from a humility standpoint, I think it's also really important to defer to the technicals because it takes the ego out of the equation. Because if I have my ego in the equation that says, oh, I think this company is going to earn $10 a share in 3 years from now, well, I could be totally wrong. But if I think I'm right, that's an emotionality, that's an ego, and it's hard to shake that. So if I could detach myself from that, I'll make better decisions as an investor, which is what the CMT will do for you, is it will help you make better decisions as a trader, as an investor, as a portfolio manager. And that's why I got it. And again, came in very handy. And like I said, 2008, 2009, I avoided that altogether because of what I had learned in the CMT and my studying for that test. It really helped me a lot in not only my career, my personal investing life, but also in my ability to share that with others. And I'm a big proponent for the CMT, and then I'm part of the association. And I would always recommend people at least give it a try, check it out. It's something that you should, if you're a serious trader, you should definitely do it.
Hmm. I got it. Okay. Um, I would have to talk to you about your institutional experience, a way where I want you to explain us how do they interact with portfolio managers? How does an institution interact with a portfolio manager in a way where you understand the criteria and you understand the guidelines by the manager, and how do you know how to adapt yourself, and how do you know how to assess your risk better in an institutional format?
Yeah, I think you used a really good word there is adapt yourself, right? Because a portfolio manager is going to have their own structures. They're going to have their own thought processes. They're going to have their own rationale for doing whatever they're doing. So the best thing that you can do is to look for ways to complement what they're doing. In other words, how could I improve what they're already doing? So and you have to learn more about their process, so you have someone who is, let's say, very focused on a particular sector. Well, then you need to obviously understand that they're very focused on that sector. They're going to know it inside and out much better than you. So from my perspective, I say, okay, where can I add value? Well, I might be able just to help them with the timing of the decisions that they're making already, because they're going to buy what they're going to buy and they're going to sell what they're going to sell. But maybe if I am able to add that other layer of dimension, and it makes them a little bit better, that equates to a few percentage points in extra alpha at the end of the year, then that's really valuable to them. And it doesn't force them to change what they're doing, because they're not going to do that anyway. So the best thing that I could do is, how do I sit alongside and make you better, right? So I think that's the way to think about it, and that's certainly the way that I've had success.
Mhm. I get it.
I think So one of the things I think is really interesting in terms of how people look at active management as being this sort of like silly thing to do versus passive investing. It's been popularized over the last, let's say, 20 years because you have a massive bull market. That's easy. But also think about like who is popularized that movement. It's been in like the mutual fund and the ETF passive ETF industry that want you to stay invested at all times because they want to keep getting fees from you all the time, right? Like no matter if the market's up or down, they know they're going to collect their fee from you. And I know that's a little bit of a cynical way to look at it, but you always have to look at who is giving you these studies that they're providing to guide you in a direction that they want to guide you. And I think one of these big arguments over the last 15 years that has cropped up was basically if you miss the best days in the market, you're cooked. Like, your returns are going to be nothing, which, it's just a very dishonest way to look at the data because what the data actually shows, and I wrote a paper on this, and it's been widely circulated at this point with two other authors who are CMT CFAs. What we found was that almost all of those best days in the market occur as bear market rallies, singular bear market rallies, like one day wonders, right? That occur
Mhm.
below the 200-day moving average, which we know is sort of the definition of a bear market. It's the definition of a downtrend, right? So basically what it's telling you, and we replicated this across not only in the US market, but in the Canadian market and Japanese market and European markets, it's the same everywhere. What it's basically telling you is that in order to receive that reward of that one day pop or whatever it is, that cumulatively is going to affect your positive return over the long term, you have to endure a horrific bear market first. And I just think that is so backward in terms of how you would think about that, right? It's like, well, why don't we just avoid the bear market in the first place and then just connect with the trend on the other side without having to deal with all that, the loss of money, the loss of capital, the loss of sleep, the loss of your psychological disposition, all of those things. In the meantime, it sort of ignores, and it just stacks those days on top of each other as if that there's nothing in between them. So I think it's a very dishonest study, one that's so widely believed and so widely circulated, that we had to actually write a paper that definitively disproves it, and demonstrates with actual numbers that this is just dishonest and not true.
Mhm. And that interpretation of active buyers lately, I guess that, in terms of liquidation and finding more liquidity in the market has risen. And due to the fact, most of the thesis that we see nowadays that are actually getting constructed by portfolio managers are actively changing towards a way where they would like to capture more liquidation because of that interpretation of active buyers. So that's a thing that we do see lately. And I want to ask you about how you can adapt yourself onto an environment where it's enough chaotic, and the environment is not just chaotic, but it's very not interpretable, and you are unable to realize buyers and sellers. Most of the logic is absent, and you still need to find as a portfolio manager an entry or an exit point to that aligns perfectly with your guidelines from your investment committee. So how do you actually reflect?
I'm not sure I understand exactly the question, but I'll give it my best shot. I guess what I would say is that, it's a matter of understanding what data is important and what data is not important, and also
Okay.
finding something that works for you, right? Because like what works for me, because of my background, because of my skill, because of my specialties, because of my 25 years of experience, is not going to work for everybody else. That's why you pay somebody like me for the expertise that I have, or you find your own way. And whatever that is, I think you need to understand why is something important? Why is something truth? Because there's plenty of data out there that is true in the sense that they're data points, but are they meaningful data points? And then, as I said, as correlations change through time, you need to recognize that just because it was important at some time doesn't mean it's going to be important again. I think like mean reversion is a great example of that, right? Where there used to be this idea that there's a mean reversion in stock prices. And it's like, well, that's true in kind of like a sideways market or a stock that is sort of range bound or trendless. But if a stock is trending, um, then mean reversion is sort of more dependent on the price trend than it is in the fact that it's going to mean revert. So you need, again, it goes back to that idea of regime analysis, right? Understanding the regime. So I think all these things point back in the same direction, at least for me, which is that like context is everything. Understand your environment, understand what regime you're in, adapt accordingly. And I say adapt, I think that's a good word you used earlier, because you cannot just always uh, press your system on the market because the market's going to do what the market's going to do, regardless of what you think, what your system says, what you want to do. The market doesn't care, you know. That's the hard truth.
Mhm. Okay. So then I really want to thank you for your insights. I do like I'm a great believer in the human sense, in human integration, and quantitative thinking streams. And I do think that we have spoken about a lot or about how to make that integration possible. And I really appreciate that conversation. And it was very educational. And as I told you in the beginning of the recording session, it's a thing we have never touched upon. And I do think that, for the listeners and for the audience, it will provide with a great understanding of an external thinking thinking process that they supposed to actually capture. So I'm very, very happy for the privilege to do that.
Yeah, my pleasure. Thank you for having me. I'll actually supply you with that paper I referenced earlier for people who do want to read about it. I think that'd be great,
The,
again, as an educational piece, something that people can sort of reinforce what I think your audience already does, which is be active, right? I think the idea of just being active but systematic about being active is incredibly important.
I do agree with you. I cannot agree with you more. So then, thank you very much. I really appreciate it. I'm grateful for the opportunity, and for you guys, thank you for listening. See you the next time.